You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 13th of November, 2023, and I'm joined by my co-host, John McEwen. In this week's episode, we'll be discussing Associated British Foods, Persimmon, Watches of Switzerland, Taylor Wimpey, AutoTrader, and our US company of the week is Disney. John, should I start us off with Associated British Foods?
Yes, Sam, and owner of Primark.
It is. It's also a company we have both liked for some time, but I don't think either of us has actually purchased.
I think after the results today, it's, regret it. But anyway, carry on.
Should see where the share price has gone in the last, because it's £23 a share now before I jump in. I think it was like 15 when we started covering it. Well, even the year low is 15. It's at 23 now. It's basically, I think, it's jumped a lot on those earnings. It's up. It's up in a year. 51% in a year. That's not bad.
That's not bad.
We followed our own advice. We'd have done quite well on that one.
Yeah.
Anyway, they have come out with full year results, and full year revenue was 19.8 billion, up 15%, ignoring exchange rate impacts. This was driven by growth in all business units as prices were raised to help offset the impact of inflation. The positive performance included a 15% increase in Primark sales. Underlying operating profit rose 4% to 1.5 billion. The associated margin fell from 8.4% to 7.7% as price hikes taken weren't enough to fully offset inflated costs. Free cash flow improved from an outflow of 84 million to an inflow of 269 million, largely due to higher operating cash flows. Net debt, including lease liabilities, rose from 1.8 billion to 2.3 billion. The group expects the underlying operating margin at Primark to improve from 8.2% to above 10% as material and freight costs ease. The sugar business is expected to deliver substantial improvements in profitability in the new year. A final dividend of 33.1p a share has been announced alongside a special dividend of 12.7p a share. A new 500 million share buyback program has also been announced and is set to be completed within 12 months, and the shares were up 6.4% following the announcement. Primark increased its store count by 27, with plans to open around 100 more by the end of 2026. And Primark's website has been given an overhaul with a click and collect trial in the UK, having been described as encouraging, and now that's been extended to women's wear. Including lease liabilities, the net debt is now 2.3 billion, but that compares to underlying cash profits of 2.4 billion, which is well below the target. In terms of valuation, forward PE in the next 12 months is 12.7, 10-year forward PE is 19.9, and the prospective yield is 2.6%. I think these are an excellent set of results. I know the underlying operating profit isn't up as much as the revenue, but they've had a lot of cost pressures. I think to get the revenue up 15% is excellent. It's quite an interesting business because it's got a lot of parts of it that are cyclical in nature. For example, like the animal feed part of the business, the sugar business, some of the, consumer goods parts of the business. Primark, I don't think is as cyclical, and we've not even touched on it on this one, but we've touched on it previously when covering it, but they are expanding Primark in America, and that does seem to be going quite well. And it's not really priced as if it needs to be successful in America. I think you could do very well, even if America was a complete flop. Although the share price is up 50% in a year, I think at a forward PE of just under 13, I actually still think it's quite reasonable. And I think for the quality of the business that you're getting, I still like it. So I think these are excellent results given how the past year has actually been in terms of cost pressures in very commoditized businesses for some of these parts of the business. And it's still not that expensive. So I really like it, as I have said the past few times. What about you, John?
Yeah, also really like it. We have said it many times before. I think we just, whilst it's remained on the watch list, haven't been brave enough personally to pull the trigger on it, and possibly seen opportunities elsewhere which haven't quite worked out, like Boohoo, for example. But no, I would agree with you. It's not, even now, it's not very expensive. And I think it's got a lot of room left to grow, particularly, as you say, in the States. So it's, I think, exciting times for Primark.
It is. Should we move on to Persimmon?
Yes, probably less exciting times at the moment for Persimmon. So it's the York-based house builder, and they had a trading statement out last week for Q3. Said they were trading in line with expectations, with around 9,500 completions expected for the full year. Dean Finch, the group chief executive, commented, trading in the period was in line with expectations and pricing was broadly stable. We are on track to deliver around 9,500 quality new homes in 2023, with operating profit in line with expectations and at an operating margin similar to the first half. While the near term is likely to remain challenging and we have remained disciplined on our costs, we continue to position the business for growth when the market recovers, as demonstrated by our further progress on planning in the period. The group's national network of outlets providing a high quality product at a range of attractive prices, which is crucial. In terms of the Q3 highlights, new home completions came in at 1,439, which was down 37% on Q3 in 2022. Average open sales outlets was up to 271 from 269, so a small 1% increase. And net private sales per outlet, however, were down to 0.48 from 0.63, so a 24% decline. And current forward sales position is £1.62 billion, down from £2.09 billion, a 23% decline. Of which private forward sales were £930 million, down from £1.42 billion, which is down 35%. The land holdings are also down from 91,300 to 84,300. The group remains fully sold for 2023, with the order book rising from £1.4 billion to £1.6 billion since the half-year mark, and Persimmon achieved planning on around 3,400 plots across 19 sites in the third quarter, and as a result now expects to open around 30 new selling outlets in spring 2024. Build cost inflation remains more stubborn than the group had previously anticipated and is now expected to be between 8 and 9% for the full year. A hiring freeze remains in place, which should see the group's headcount fall by around 700 in 2023. And full year completions, as I mentioned before, are now expected to be around 9,500 compared with previous guidance of at least 9,000. Cash balances are expected to be in the range of between 300 and 500 million pounds, and shares were up 1.5% in early trading. In terms of valuation, Persimmon has a market cap of £3.74 billion and trades at a forward price to book of 0.98 and has a prospective dividend yield of 5.3%. I think these results were broadly what we'd expected and what the market was expecting too, perhaps slightly better. Shares didn't respond too badly, up slightly in early trading. It is obviously disappointing to see the new home completions coming down, but it's a cyclical business. We know where we are in the cycle, and I think with interest rates as high as they are, again, it's no surprise. They're very cheap at the moment, and I think we'll be saying similar around Taylor Wimpey too. I think the fundamentals for the UK housing market are still very strong. There's a great supply-demand imbalance, and that's in the long term only something that's going to be benefiting Persimmon. It's a lot healthier. It's got a decent amount of cash than the businesses had back in 2008. So I'm still retaining my position in a house builder, which happens to be Redrow, although I have owned Persimmon in the past, and just sitting back and waiting for the cycle to roll on to the next boom. So, what are your thoughts?
Some signs of life. It was quite encouraging, I thought, compared to the last few that we've seen. I think it's good that the order books started rising again, especially when prices have risen. I know they've not risen in line with inflation, but given the pressures that have probably been on pricing, on the demand side, I think a price rise of 2% is pretty good in the circumstances. Build cost inflation, higher than they expected. I don't know if the target was just a bit ambitious, because I think they were targeting, what was it, like 4 to 5% or something, which, it was a made-up number anyway, wasn't it? So You can't be too surprised when it's wrong. And full year completions planning to be slightly higher than previously planned. I think it's pretty encouraging. It's obviously still not a great situation that they're in, but it is encouraging. What's the price to earnings?
It is 4.65.
Yeah, so it's pretty cheap as well. I appreciate it could still have a lot further to fall, depending on what happens with the housing market and where it is in the cycle. But I think it's a pretty reasonable valuation for a very good business that seems to be doing slightly better, with the main metric for me being the order book. Should we move on to Watches of Switzerland?
Yes, so it's a company we haven't covered in a while.
No, so it was one of the first companies we covered, and I don't think we've ever looked at it since. So, Watches of Switzerland have come out with half-year results to 29 October 2023. And in the second quarter of the half, they've said that US revenue was 165 million, which was up 11% in constant currency and 4% reported rates versus prior year. Luxury watch sales strong across brands and price points. 6 new monobrand boutiques open in the US for Breitling, Tag Heuer, and Grand Seiko. 3 at Canal Place, New Orleans, and 3 at Fashion Place, Utah. UK and Europe revenue was 214 million for the second quarter of the half, in line with the prior year. The performance continues to be driven by domestic clientele across the UK. Several high turnover Goldsmith and Mappin and Webb's showrooms were closed for upgrade during the period and were trading out of pop-ups. Successful launch of Rolex certified pre-owned in the UK in September 2023, encouraging early client engagement and trading. They've agreed the purchase of 19 luxury watch showrooms from Ernest Jones, comprising of 14 multi-brand showrooms and 5 monobrand boutiques. And for the half as a whole, group revenue was 761 million, and that was up 2% in constant currency and flat at reported rates. Luxury watches revenue was 670 million, up 3% in constant currency, flat at reported rates, representing 88% of revenue, and that's up from 87% a year ago. Luxury jewellery was down 15% at constant currency and down 17% at reported rates to 47 million. This reflects market trends impacted by overall consumer sentiment and by a repositioning to full price sales in the US. Continued strong momentum in the US with revenue of 328 million, up from 311 million, which was 11% in constant currency and 5% at reported rates. UK and Europe performance was driven by domestic clientele with revenue of 433 million, which was down 4% versus a year ago. Group e-commerce sales were down 4% on a year ago at reported rates, against strong comparatives in the prior year, and impacted by the high proportion of jewellery sales through this channel. The adjusted earnings before interest and tax for the half is expected to be 70 to 72 million, and that's down from 87 million. And for the guidance, they're guiding for growth of 8 to 11% for the full year and an adjusted EBIT margin in line with the 23 year. And their operating cash conversion is expected to be about 70%, weighted towards the second half in line with seasonal patterns. If we go and look at the financials, in the year ended 28th of April 2019, they had revenue of 773 million and operating profit of 45 million. Compare that to the full year just gone, 30 April 23. Revenue had basically doubled to 1.542 billion, and operating profit had more than tripled from 45 million to 178.6 million. And that has flowed through into the earnings per share, which are up in that period, the 5-year period, from 11.8p a share to 51.5p a share. And the business trades at a price to earnings of 11 with no dividend yield. I can't really remember what we thought last time we looked at it. I can't have been that impressed because I never looked at it again. I don't think these results are astounding, although it looks like in the past sort of 2 or 3 years since we have last covered it, it's put up some very, very good results, which we have missed.
Yeah.
I'm not really sure what caused the increase in revenue, that doubling over the 5-year period. My instinct's acquisitions, but then it's flow through into earnings per share. So if it is acquisitions, it doesn't look like it's been funded with any issues of new shares or anything. Let's see what the interest has been like. And net interest hasn't really changed either in the 5 years. So it doesn't look like any interest in debt, any increase in debt or anything. So I'm not really sure. I'd have to go back through and figure out what's happened. The issue is, and I suspect it's the same issue I've got last time, they don't really own the brands. They're just selling them. So I don't, I mean, on the website, they tell us how they create value. They talk about partnerships with the brands, the showroom environment they create, the client experience, the marketing, the multi-channel. But at the end of the day, they do just sell watches, and they might be an upmarket seller of watches, but it's kind of the same. In fact, it's the same issue I have with JD Sports. They're not in control of their own destiny. I just don't like that. Because if I'm buying a watch, I'll look at different types of watches, but then once I've found the one I want, I am pretty much solely guided by price. There's no reason why I'd get it off the watch shop compared to someone else.
Yeah.
Other than it's cheaper. So I don't think they've got any sustainable competitive advantage. They appear to be operating very, very well, but without their own brands under their umbrella, I don't think there's anything that would make me interested in this business, no matter how well it performs operationally. And it does look like it is performing well operationally, in fairness to it. What about you, John?
Probably similar. And I guess an example would be like LVMH. Owning a business like that compared with this or JD Sports, it's not expensive. So I guess some of that, what you say, despite it being very well run, but obviously not owning any of these brands, is reflected in that price. What did you say, 11 times earnings?
Yes.
Yeah. So I think you could do a lot worse, but I think paying up for the quality would be my preference.
Yeah. Shall we move back to our second house builder of the week?
Yes. So it's another trading update from Taylor Wimpey this time, another one of the big house builders. They said that their weekly net private sales rate since the half year was 0.51 per outlet, in line with the same period last year, despite the high mortgage rates and the negative impact on consumer affordability. On the 5th of November, the total order book, excluding joint ventures, stood at £1.9 billion, which was down from £2.6 billion last year. And build cost inflation has continued to moderate over this year, in line with the group's previous expectations. Total completions guidance has been maintained, with the group expecting to deliver between 10 and 10,500 homes this year. But full year operating profit is expected to be at the top end of the group's 440 to 470 million pound guidance. And after dividend payments of around 338 million pounds in 2023, the year-end net cash position is expected to be in the range of between 500 and 650 million pounds. And again, the shares were up about 1.5% in early trading. In terms of valuation, Taylor Wimpey has a market cap of £4.2 billion and trades at a forward price to book of 0.91, compared with a 10-year average of 1.52. And it's currently, well, in fact, its dividend yield, it's on the basis of the asset value, and it hovers around the 8% mark, I think. We have liked Taylor Wimpey in the past. It's another house build that I have owned. It took advantage of the COVID situation and did an equity raise and bought more land as the market bottomed back in the COVID pandemic, which turned out to work quite well. I think it still has for the business. And I suppose, as we said with Persimmon, it's, if you compare the numbers with the top of the cycle, disappointing, but actually there is still some life in the sector, even where we are in the cycle, and perhaps things are beginning to turn a little bit. And as we always say, there's that structural imbalance for houses and the demand supply in the UK. So I think, like Persimmon, it's in a very strong position going forward. I have Redrow. I'm happy holding the shares. I think there are definitely some differences between the companies, but they all trade at similar valuations, and I think they are all of decent quality. I've owned 3 of them now, and I haven't seen huge amounts between them. I think Persimmon at the moment is trading at a slight premium and I think Persimmon does make perhaps half the bricks itself, so it has slightly better control over that price. Although I appreciate it was slightly over in terms of some of the inflationary pressures on it. But yeah, I don't think you can criticise, I suppose, too much where, as we said before, where we are in the cycle.
I also think, given where we are, similar with Persimmon, I think Taylor Wimpey, I don't think the results are too bad, all things considered. It would be interesting if we could see how the order book had done since the last quarter, but it's a trading statement, so we just get the information they give us. But it would have been nice to compare it to Persimmon, where although it's down for the year, for the over the past 3 months, it had actually started creeping up again.
Yeah, I don't think it.
No,
I don't think
so.
another quarter.
Operating profits at the high, at the top end of the guidance. I don't think it's too bad, all things considered. I think there seems to be more singing and dancing in the Persimmon trading statement, which seems to suggest that maybe Persimmon are having a slightly better time than Taylor Wimpey are. But all things considered, they don't look too bad. What's the price to earnings on this one?
It is 6.2.
Feels a bit pricier.
Yeah,
I'd probably go with, based on that. I mean, it's very surface level, but I'd probably go with Persimmon. It seems to have had the better trading statement.
Persimmon is more expensive on the price to book.
Okay.
There's
might be why.
Yeah, it's where is it? So 0.91 compared with 0.98.
It's got dividend yields about the same though, about 8% for both. I know.
I think
it's slightly higher.
Yeah, exactly. I'd have to check the Persimmon policy.
So that's a 7.8% forward yield compared to 8.1, but they're pretty similar. But yeah, I like them both. Should we move on to another business that we like?
Oh yes, AutoTrader.
Yes. So AutoTrader have come out with their 6-month results for the 6 months ended 30 September 2022. And AutoTrader's core marketplace business grew revenue at 9% and operating profit at 10%, with operating profit margins remaining above 70%. Total group revenue increased by 12% and group operating profit increased by 10%. Average revenue per retailer grew 12% due to continued strong adoption of our additional products and services and a successful annual pricing and product event in April 2023. The used car market continues to be resilient. The volume of buyers on AutoTrader is at record levels, supported by stable consumer sentiments towards car buying and the continued availability of finance. The supply of used cars has gradually improved as new car registrations grow. Used car pricing has remained robust, and vehicles continue to sell on AutoTrader quicker than pre-pandemic levels. We're making good progress scaling our deal bundle product, which allows car buyers to value their part exchange, apply for finance, and reserve the car online. We've had about 500 retailers trialing the service at the end of September 2023, and that's up from 50 in March. We've completed 2,100 deals in the period, up from 200 a year ago. Structural changes in the new car market are providing opportunities for growth. We've launched a new car market extension product, allowing manufacturers operating an agency model to advertise new cars directly to consumers. We continue to integrate our new car leasing proposition, Autorama, which has yielded some cost savings and should benefit from volume growth when supply returns to this channel. So revenue is up 12% to 280.5 million, and that's split by a 9% increase in revenue for AutoTrader to 259.4 and an 82% increase for Autorama to 21.1 million. And the operating profit is up 10% for AutoTrader, but down 40% for Autorama. However, it looks like they're just trying to scale it at this point, and it's still, when it's only 10%, less than 10% of revenue anyway, it doesn't really matter. Basic earnings per share is up 4% to 12.74p a share, and cash generated from operations is up 12% to 184.2 million. 117 million was returned to shareholders, and that's up from 82.3 million a year ago through 65.8 million of share buybacks and dividends of 51.3 million. Over 75% of all minutes spent on automotive classified sites was spent on AutoTrader. Cross-platform visits were up 14% to 77 million per month. Cross-platform minutes were up 11% to 555 million minutes per month. The average number of retailer forecourts in the period was down 3% to 13,710. However, excluding the impact of the web zone limited disposal in October 2022, which meant a loss of 543 retailers over the period, like-for-like retailer numbers were up 1%. Average revenue per retailer was up 12% to 2,683. This was driven by the price and product levers with a slight decline in the stock lever. Live car stock on site was broadly flat at 439,000 cars. On average, within our listings product for new cars was only 23,000 on average. In terms of the valuation, the business trades at a P ratio of 25 and has a yield of 1.2%. It's probably more like 2.5% when you factor in the buybacks. I think these are excellent results. I think the business is, doing all the right things to increase revenue. I think the Autorama acquisition looks very encouraging. I think the new car changes that they're making looks good. And I mean, some of the changes look incremental, but I think Autorama, I think they could do very well out of that. I think that could be a significant part of the business at some point. So yeah, I think these are excellent. It's not a cheap business at 25 times earnings, unfortunately, but it is a very high quality business, and it is, as we've seen, what was it, 75% of all time spent on automotive classified ads is on AutoTrader. It is a monopoly, and unfortunately, you do have to pay up for monopolies. If this was ever at 10 times earnings, I would go to town on it, but I just don't think we're going to see it. I mean, we've covered it in the past when it's at 20 times earnings. Maybe it'll contract a bit from the 25 because it just seems to be riding quite high at the minute, but I think this is probably always going to be an expensive stock, and probably justifiably so when it's putting out results like this, and it's got such a strong moat. Whereas you compare that to Watches of Switzerland, which I don't really think has much of a moat at all. I think if you were determined enough and had enough money, you could take on Watches of Switzerland. Whereas, you could give me a huge marketing spend, I think I'd really struggle to dislodge AutoTrader. John, what are your thoughts?
Yeah, I mean, I think really, really impressive results. And I think as well, when you consider that we're in this high interest, well, I say high interest, relatively high interest rate environment, certainly compared with the last 15 years, and then AutoTrader is still able to do this sort of thing. It's, a testament to the quality of the business. And it's certainly difficult to criticize. I suppose you might try and argue where the growth, the long-term growth going forward comes from. I guess some of these acquisitions, Autorama is, one of those avenues, but beyond that, perhaps it's, more difficult to see, a bit like Rightmove, and whether it would go into any other markets, it's tricky, but I think it's an excellent business. Like you say, really strong moat, and it's benefiting from essentially being a monopoly.
I'd rather it expanded the way it has than if it was like, oh, we're going into the Netherlands, we're buying a business in France.
No, it's just.
But no, I like the strategy, and I like the business. Not as huge a fan of the price, but that's life. Should we move on to a business that we like even more?
Yes, well, it's been tested recently. It's Disney. They had their Q4 results out, with fourth quarter revenue rising 5% to $21.2 billion. That includes a 13% increase in streaming revenue to $5.6 billion, which offset declines in the traditional linear networks. That meant that overall entertainment revenue was up 2%. The number of global Disney Plus subscribers, excluding Hotstar internationally, rose 7% to 112.6 million. And subscriber numbers overall were better than expected. Experiences revenue rose 13% to $8.2 billion, reflecting a strong rebound in international parks. Group operating profit came in at $3 billion, which was much higher than last year's $1.6 billion. That was helped by the improvement in the theme parks, as well as narrowing losses from the streaming business. Free cash flow more than doubled to $3.4 billion, whilst net debt of $32.2 billion was lower than the $36.8 billion at the same time last year. Disney expects to reduce costs by a further $2 billion, but this won't be coming at the cost of further job losses. The shares were up 3.3% in after-hours trading. In terms of valuation, Disney has a market cap of $157 billion and trades at 18 times forward earnings, compared with a 10-year average of 23.4, and it currently yields just under 1%. I thought these results were much more encouraging, and particularly seeing those subscriber numbers going up, excluding Hotstar, but they were less cash generative anyway. And also the parks, the experiences going up 13%, really, really encouraging. Debt coming down. You feel that the turnaround with Disney is really beginning to gather pace. And it's a company that I've owned for a couple of years now and very happy. And I'm glad to see the turnaround is beginning. Sam, what are your thoughts?
Pretty similar. I'm very happy with these results. Yeah, this is really, since Iger's come back in, it is a bit of a turnaround. But it's, the revenue growth is fairly decent at 5%. Streaming revenue's going up 13%. And that's 5.6 billion, which is not a small amount. The streaming revenue, is like it's about a quarter of the total revenue. So it's not tiny. And I think obviously they had a decline in the Disney Plus subscribers last time we looked at them. That was mainly due to Hotstar, which they've excluded this time. But we did make the point last time, the Hotstar, that was more in countries like, well, I think it was like mainly in India, and it was because they'd lost the cricket rights or something. But these subscribers were nowhere near as valuable as the Western ones. And when you strip the Hotstar out, they're up 7%, which I think is a pretty decent number. I think the debt's starting to come down nicely. So, down from 36.8 billion to 32.2 billion. It was, it wasn't that long ago, it was over 40 billion. So it's come down by almost a quarter. I'd probably like them to slash a dividend and just pay off the debt with it. Because, if they could get this to this business to a point where the debt's basically gone, it would just be much better. I'd prefer that than a 1% dividend. But yeah, I think since Iger's come back in, I think he's done all the right things. There's not really anything I'm sat there thinking, why has he done that? What's he doing this for? I think it does look like since he's come back in, it looks like there was quite a lot of fat that he's been able to trim. It doesn't really feel like any of the cuts that have been made have really made the business any worse. And I think the valuation, 18 times earnings for a business of this quality, possibly the best business in the world. Certainly one of the best businesses in the world. Yeah, I think at 18 times earnings, I really like it, and I think it's moving in the right direction.
Would you buy more shares?
I've already got quite a lot. I wouldn't be against buying more, I don't think. But I've got, of my US holdings, so I think I've only got four US stocks now. So I've got Mercado Libre, which is quite expensive, and that's obviously done very well. That's up over 500%. I've got Etsy, which is down overall, because I've been adding to it on the way down, although I think I originally bought it at like $50 a share, so my original position's still up. I've got PayPal, which is down about 20-25% overall, and I've got Disney that's down about 15% overall. It's very, very difficult what I add to next out of Etsy, PayPal, and Disney. I'd possibly go for PayPal over Disney, but I think PayPal's a smaller position and also it's cheaper. But yeah, I would not be against adding to it in the near future. I really like the business. I think it's a great valuation. I actually didn't mind the valuation when it was 75% higher. I thought it was justifiable given the quality of the business and what I thought the future of streaming did look like in the longer term. So yeah, it's down like a third to 40% since then. I really like it. What about you? Would you top up in the near future?
Potentially, yeah. I think this is a really encouraging sign. I have topped up on the way down, but it's still not a huge position for me, and certainly not my largest. So I think there'd be scope for it. And yeah, I think this is really encouraging. So I might do it on the back of these.
And as well, although it's rallied a bit, it's only up 10% from the lows. It's still down. It was as high, what is it, $90 a share now, basically. It was up at like $170, $180 a share.
Yeah.
So it's still got a long way to go just to get back to where it was. And I thought that valuation was justifiable.
Yeah.
I think if it were to go back to that valuation, I don't think I would sell. I think I would probably carry on. I'd stop adding, but I would probably hold on to it, even if it went back to the values it was at. So,
on that note, then, which company would be your top pick, and what would be last?
So top picks probably quite easy. That's Disney. The only business in there, having said that, ABF's a very good business. AutoTrader could have possibly given it a run if the valuation had been lower. But yeah, it's definitely the best business. And then I actually think it's one of the best valuations as well. In terms of last pick, it would be Watches of Switzerland. It did actually look like a business that was putting up good results. So I think it's unfair to sort of brand it as a loser this week, because it does look like operationally a very good business. But the issue I have with it is it's just got no control over its own destiny. Where, compare that to Disney. They own all their brands. No one's going to come and take their brands away from them. Whereas, if the watchmakers want to go direct to consumer, or if someone else just wants to come and sell the same watches, they can do that. Whereas Disney just don't have that issue. What about you?
Disney would be my top pick. And again, without being boring, it would probably be Watches of Switzerland. I think if you were to ask me for my UK company of the week, it would probably be ABF. And AutoTrader, great, but it's just a lot pricier. I think ABF has got a lot of grade ahead of it, and it's not that expensive. In fact, it's probably you could even describe it as cheap.
Although it is foreign, Watches of Switzerland is listed in the UK though.
Yeah, but it still wouldn't be my,
No, it just doesn't interest me. There's not really anything they can do. Maybe if they brought out some of their own brands and they seem to be going quite well, I'd take a look at it. But if they're relying on someone else's brands, I just don't like it.
No, absolutely. Okay, well, thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.